All right, in today's video, we are going to take a look at a case study where we've got a real estate investor who started a policy back in 2020. He's got a goal of funding the policy with about $1.2 million. You see, it's a little bit more than that, and he's on track to do that. So we're going to look at the policy performance. We're going to look at using the policy for real estate as he has been doing that, and we'll show you the workbook and calculator that he really likes to use so we can just get a quick ballpark of how's the policy performing, and if I use it to take a loan and invest in real estate over here, how much am I paying in interest compared to the actual cash value growth, and it helps him make an informed decision. We'll look at that, but we'll also go through some of the questions he had regarding the funding and then also regarding the growth. He asked some really good questions when he was looking at the policy performance that a lot of people ask. So his questions, in my opinion, are good questions to hear if you're interested in a whole life insurance policy or if you have one already, just so we can hear what others are asking. That way we can ask the right questions. So let's get on into it and have some fun talking about cash value life insurance. So he started the policy at age 48. He started back in 2020. We're shooting this video in 2023. You'll see the performance during the first and second year. He's in policy year 3 right now. Now, when he started his policy, he had a 1035 exchange of a little more than $173,000. You'll see the exact dollar amount that was transferred into this policy. And his planned funding and what he has done thus far is $80,000 per year. The goal is to fund through the age of 60. So when I say through the age of 60, his last $80,000 he wants to pay into the policy at age 60, not until age 60, which would mean his last payment would be at age 59. Small detail, but very important because that's another $80,000 going in. Now, what I will also add is he's got his policy set up where he's only committed to the minimum each year. It's a little bit more than that, but the amount he's billed for, which is his base premium, plus the term rider, is $12,500 per year. And for the first 2 years, I believe he funded the $80K, boom, first and second year. However, in year 3, he initially funded the $12,500, and then a little bit later during the year, he added the additional $67,500 for a total of $80,000. So he has benefited from that flexibility, being that he's involved in real estate. What happens sometimes? You know, if you're involved in real estate, cash flow fluctuates. The timing is not always what we expect, at least not until things are really rolling, if we've got a lot of cash flow coming in, but things can fluctuate. So from a flexibility standpoint, that has really worked to his benefit, and I'd imagine it will continue to do so, where he is committed to an amount that never feels like a burden. He can also make some large payments in the future, which we're going to demonstrate that. But let's continue on here. So $80K per year, total input, $1.2 million. Now, why I used that word, total input, is because what he's going to be paying into the policy with his cash will be $80,000 per year. However, the 1035 exchange was money that came from an older cash value life insurance product. It was a universal life type product. And just in analyzing that, looking at the guaranteed, non-guaranteed values, he decided to transfer it over. But we are going to include this in the $1.2 million. So when you see the total payments added to his whole life insurance policy, it'll be the $80K per year plus the $173 and change. Now, here is a really good question he asked. And I say it's a really good question because this comes up so often with life insurance products that have cash value, which is this. Where can I see how much my policy grew by? Where can I see the growth is the question. Is it on my online account? Is it on my annual statement? I just want to know what the cash value grew by this year. I don't want to see my $80,000 included. I just want to see the total amount of guaranteed interest, dividends, the total dollar amount the insurance company gave me. Can they provide that? The answer is yes, they can, but they typically do not. I wish that they did. We've got this word here. Do you mean the dividend? Because they will provide a dividend. You'll see a dividend on your annual statement. You'll also often see it on your online account. If it's a universal life type product, you'll often see credits or the crediting amount. However, that rarely, almost never, represents the true cash value growth. For example, if your cash value is $100,000, you receive a dividend of $5,000, but then your cash value the following year, we'll assume you pay nothing, your cash value is $106,000. How much did it grow by? $6,000, not $5,000. So what's going on here? Well, the dividend is not going to reflect the total growth on a policy. So to get the total growth, we actually do that ourselves for clients we work with. So as we have review meetings and provide updated reports, this is one of my favorite things to do, is to see exactly what the dividend was, but then also see what the net cash value growth is. So let's take a look at that actually, and then we'll progress on to the second point that he asked, because this is an excellent question. So we'll begin with the original plan, which is an in-force illustration, still funding it through age 60. His original plan was to fund a little bit longer, but we actually built these policies or built these illustrations during our review meeting. And he was like, hey, 60 is good. Let's stop there. All right, we can go longer. Yep, 60 is good. It's just a clean age, makes things very, very easy. So we see male, preferred plus. He received the top health rating, started in September of 2020. Started at age 48, not a mech, beautiful, okay. He's got an outstanding loan here. However, in this illustration, we are assuming that he pays it off in full. That's why we see a payment in policy year 3, because he's already funded it. And as of right now, he does not plan on adding more money to the policy. So the net premium in year 3 is 0 because he's already paid that. So what do we got here? $80K per year through age 60. All right, that's great. What else do we got? Here's the big thing we wanted to hit on. End of year dividend. So year 3, it's $58.48. Year 2, which is not on an in-force illustration, we would have to take an in-force illustration from last year or look at last year's annual statement. But the second year dividend, meaning the dividend column, was a little bit more than $5,000. So this can be tough unless you have a calculator. Why don't we take a calculator and then we'll look at Excel. But just follow along with me here if possible. Pretend this is you. Year 3, the end of this year, this is September of this year, you've got how much in cash value? $414,003. 414,003. Cash value, the next year is 507,509. So why don't we do this actually? 507,509 minus last year's cash value, 414,003. So that's the gain from year 3 to year 4. However, don't go so fast. We do need to back out the payment you made. He added $80,000 to the policy, so the cash value did not grow by $93,506. I need to back out the actual dollars he paid into the policy. So let's subtract the $80,000 he added in year 4. Look at that, $13,506. So what do we have going on here? Well, we see it was $414. He paid in $80. But then the actual growth from the insurance product or from the insurance company was $13,506. So that $13,506, is that more or less than the dividend column? Yeah, it's more than the dividend column, isn't it? We're going to look at last year's too. We'll look at it from year 1 in a minute when we look at the actual performance of the policy. So my point to that is this was an area of confusion when he's looking at his policy and trying to find out what the policy is growing by. Because it's his money. He wants to know what the growth is. And when he looks on the online portal and spends time digging into everything, we cannot find that answer from the insurance carrier. And this is the case with almost every insurance carrier, finding the net number. So one thing you can do is crunch it with a calculator. Another thing you can do, what we like to do, is lay it out in a spreadsheet. It makes it a bit easier. Let's start with this. So what we've got here is that illustration we just saw, but it dates back to day one. So day one, there's the 1035 exchange. 173, 828 all went, or 823, I'm sorry, all went into a PUA payment. Then we've got the premium and PUA payment at $80,000. So the total payments, this would be the total input, which is what we were referring to earlier. $253 in the first year, cash value $237 and change. What is highlighted in this beige yellow here is what's already happened. He's already paid in $80,000 years 1, 2, and 3. These figures are pulled from the annual statement as we track the actual performance. And here we can see the annual dividend. Looks familiar, right? Consistent with that illustration. This isn't consistent. Well, it's not consistent because this is year 2. We pulled this from the annual statement. There's the growth in year 2. Year 3 a little bit lower, which is often common with that L95 product. Then we'll shoot back up. Look at that. There's the 13,506 in policy year 4. When we looked at year 3 to year 4 in that example. So I do like to look at the net cash value growth year over year. So I can just see the net dollar amount that I received. And if you prefer percentages, we would add an IRR report there. We can look at the annual and average if we prefer. So there we go. We're going to come back to this in a little bit, but let's continue here. So where can I see how much my policy grew by? We can't see it. It's something we have to put together, and we do put that together for everyone we work with. I actually enjoy it quite a bit. It's really neat to see. Now, the funding. The original plan was what? $80K per year through age 60. What if, however, what if I add a lump sum to my policy at age 55 is what he asked for. And he had asked this question because when we set that policy up to be able to fund it $80K per year for 12 years, initially it was a little bit longer than that, from a policy design perspective, without getting too deep into the weeds, to fund it for a long period of time with Guardian, which is the company he went with, we have to overinflate that MEC limit. And we need to add enough term insurance to the policy so the policy can handle the funding that he wants to pay in while maintaining a low base premium. That's what he wanted to do. So we searched for the most optimal design. This was it. So my point is, we have to overinflate that MEC limit. So what he can do in this particular case, this is what prompted the question. He saw the total MEC space that he had on the policy, because we would provide that in our report every 6 months when we reach out to individuals. And he said, can I add that money now? The answer is yes, you can add that. However, what's important to be aware of is if you add that large PUA payment, your term rider is going to shrink a bit faster. And you can think of it this way, almost as if you're buying up the policy faster. So if your plan, Mr. Client, was to fund the policy with a total of $1.2 million by age 60, you get that $1.2 million in by age 57 or something like that. The term rider will burn out faster, so you're able to get the same dollar amount in, but in a shorter period of time. Okay, that makes sense. How does it impact the policy? Well, it performs a little bit stronger, actually, because we're getting more money in faster. That's if the insurance company accepts it, which they usually do. We've experienced that. They reserve the right to enforce their basic limits, but we typically do see them accept that, and the numbers look good. Okay, I'd like to see some examples of that. Well, we shall show you some examples then. So we're going to look at a lump sum here going in at age 55, and the funding will be just about the same. So what we've got here, or what's important to do this, is a one-year term rider. This is going to prevent medical underwriting. You're going to see at age 55, this lump sum payment is $340,000. When you add a big PUA payment like that, that's going to buy you more whole life death benefit can look at the exact numbers, but just to ballpark it, at his age, somewhere between $700,000 and $900,000 in added death benefit. So if you've got a 1-year term rider, what's going to happen is your whole life death benefit will go up, but your term rider will go down, and your net death benefit will stay the same. So you'll see his net death benefit is $4 million. Regardless if he makes this big PUA payment or not, his net death benefit, meaning if he dies, remains at $4 million, as long as the term rider is still attached. The important item to note there is this is what allows for that. And it makes the insurance company much more comfortable when accepting large PUA payments. Because if that 1-year term rider is not there and you want to make a big PUA payment, your death benefit increases and they can view that as a liability. Meaning, hold up, before we accept that money, because we're on the hook now to pay another $700,000 to $900,000, we want to check your health. However, if you have this 1-year term insurance rider attached, we'll accept it because we're on the hook for the same amount. We've got other videos that provide a breakdown on that term rider, but it's very beneficial to be aware of that. The other item, from a MEC limit standpoint, we do need to have enough MEC space to make a big payment like this. Catch-up payments, when we talk about making up for lost time at the MEC limit, is what this would fall under. So let's take a look at this. This would be pretty cool. And let's start with the illustration. Here we go. Same thing. So there's your cash value at the end of year 3, year 4, same thing. What do you notice here though? Year 8 at age 55. That was the question. Hey, what's it look like if I throw in $340,000? He's involved in real estate. The assumption here is if I sell a piece of property and have a big pile of cash, can I pump it into the product? The answer is yes. Here it's illustrated. This is fun designing this on the call with individuals. This is the kind of stuff I nerd out on. I could just sit there and run the numbers all day long. So there's the funding, then stopping it after year 10 at age 57 in this case. So let's go back to our side-by-side comparison. And I made a small mistake here that absolutely drove me nuts after I found out and sent it to him. Was the fact that I should have made this $60,000 in year 10. Because look at the total payments. 1.233 compared to 1.213. Not a big difference, but this guy already looks more favorable because I'm getting money in quicker, and I put in another 20 grand. So it is not a true apples to apples comparison. But anyway, we can correct that easily, that kind of stuff. Just when I make mistakes like that, I'm like, darn it, Steve, why'd you do that? Anyway, let's look at the performance here. So there's the big lump sum. Age 55, total payments now at that point, almost $1.1 million. Compared to over here, you're at $800,000 and change. So you got more money in fast. Now, what's interesting about this, look at that particular year, got more cash value, which is great. You're at 1.18 compared to here, 920. You're analytical. That probably jumped out at you. The net cash value growth. Why did this one be a little bit lower that year with that big payment going in? That big payment does have PUA fees associated with it. And this is the net cash value growth after the fees are assessed. So you've got a fee assessed to a large dollar amount. So the year you make the payment, we are going to see a little bit of an impact, but you will see a positive impact. Look at the next year. Now that it's compounding, now it really starts to move forward, where most look at that and say, okay, I'm good with it. Like, yeah, it moves quick. But I want the disclosure there. That's very important just to be aware of, to see how much of that shows up in cash value right out of the gates. But there we go. There's the performance there with the heavy funding. And this is something he's interested in. He's interested in potentially adding larger lump sums earlier than age 55, but this was the example he wanted to see. There was one more example where we looked at 240 here, and then smaller or higher dollar amounts than 80K, years 9 and 10, same total input into the policy in terms of dollars, but just different creative ways to get the funding in. So this is cool because we can see how to maximize the cash value, but let's look at the last step here, which was this. Policy loans. He wanted to see some numbers. I'll show you what he wanted to see. So as we look at our loan workbook, he enjoyed this quite a bit. So first year, the annual outlay, that includes the 1035 exchange, the 253 and change. That's the 80 plus the 173 transfer. Okay. Then we've got total payments, cash value, death benefit. Annual IRR looks pretty good. That 1035 exchange is what did it. Yearly cash value growth. Okay. Total gain on cash value. This was not on the last sheet we looked at. So he's in year 3. Available equity is 95% of whatever his cash value is. Let's say he takes out a loan. Let's do it in year 4, actually, which will be September of this year. 400. What was his available equity before that? 482. And what I'll say very, very quickly is this loan, this workbook, does not display direct loans from a life insurance policy. It's meant just to provide a quick snapshot of what the numbers might look like. The actual numbers will be different. They'll be close, but they will be different. We put this together mainly for cash value collateral loans, but we plugged in the loan interest rate of his life insurance policy. And if he took a $400,000 loan and it was a direct policy loan, what would happen to that death benefit? Remember the life insurance policy? Dollar for dollar reduction. We would see it 3.6 until the loan is repaid. So there's the loan. There's the interest. Total interest payments here. Let's look at this. This is what we're interested in. Side by side, I can see what the cash value is growing by each year compared to what I'm paying in loan interest each year. Here, I can see the total gain on cash value compared to the total amount I've paid in loan interest. So, what we looked at in this particular case, we actually looked at 350 initially. Now that my memory is coming back, 350. No, I'm sorry, it was 300 because he paid it back then at $75K per year. And he took 300 this year. There we go. Because the plan here was to repay it before he adds that large lump sum of 340. So 300K loan in policy year 3. What I can look at, $300,000 loan, annual interest paid about 17 grand, cash value growth that year, $6,500. In the red, about $10,000. Someone might change their mind there and elect to take a little bit lower loan. Some would say, hey, that's perfectly fine. I view it as a low-cost loan, but I get to see the numbers. Total gain on cash value. I did break even year 3. I've got a $180 gain. But if I add interest to the overall plan that early, I'm in the red there. Now, I begin to repay it, $75K per year. Keep in mind, you're still adding to the policy here. But back to this side, if I pay $75,000 toward the loan, what happens the next year? The cash value growth and interest paid are almost even. Over here, I'm still behind when I look at the total growth compared to the total interest paid. But I can look at this on an annual basis. Now, if I don't add more to the loan balance, well, then what's going to happen here is the growth is going to exceed the interest paid. The reason why is because I'm earning on the entire cash value, and I'm paying only on the outstanding loan balance. Being able to play with the numbers and see what's the max I can take and what will make me always be in the red compared to never be in the red, that's where numbers help quite a bit. I hope you enjoyed this video. I did quite a bit. I had a lot of fun putting this together. If you have any questions, please let us know. Leave them below in the comments or feel free to reach out to us. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.